Well, today's property player is taking profits on investments in the U.S. residential housing market so he can plow fresh money into commercial real estate. He is betting on what he calls sand states, Florida, Arizona, and also Southern California, where real estate is still troubled and it is still cheap. Stephen Hagenbuckle is the founder and president of TerraCap Partners. Steve, great to have you with us.
Thank you.
And as I understand it, you're raising money for a new fund.
Correct.
Is that right?
It's our second fund.
Your second fund. And how much, or where do you want to plow this money? Why in the sand states?
Well, that's where the impact was greatest as far as the depreciation in values. On our first fund, we focused on residential. We felt the right time to buy residential was between 2009 and 2011. Now we're seeing a lot of increases in medium home prices since then. For the last 2 years, on average, between 20% per year upride. Commercial tends to follow residential, and we focus on the secondary markets because the big players are bidding up all the prices in the primary markets, whether it's Chicago, New York, San Francisco, markets like that. They're bidding the prices up too high to replacement costs, or sometimes higher for those trophy properties.
So that's why you're going to secondary cities then for commercial real estate.
Correct, correct.
Okay. Steve, let me just, before we get more to commercial, I'm curious about the residential part.
Sure.
So you said you bought several years ago into, were you buying into single-family homes or multi-family? What were you buying into? We
were predominantly focusing on residential development sites. So we were looking in areas where there was high demand, long-term, sustained population growth. So, for example, let's just use Florida. So we would buy residential sites that were previously owned maybe by Lennar, D.R. Horton, Toll Brothers. We bought them at about 20 cents of the debt, which is about 15 cents on what was previously paid, and now we're exiting those investments at about 2 to 3x equity multipliers.
Oh, really?
Oh, absolutely.
And these were foreclosed properties or in foreclosure?
Yeah, they were acreage that was approved for residential developments, would ultimately be gated communities, correct.
But what I hear, Steve, though, is that there's plenty of foreclosed properties out there still. I mean, the housing market has clearly not recovered, and in fact, Sam Zell said to us earlier that, it hasn't recovered, it's not recovering to the pace some people are saying. So isn't there opportunity?
There is opportunity, but the spread, as I mentioned earlier, has been compressed now. The big opportunity, the bottom of residential to buy was in '09. So, as I mentioned, it's been going up for the last 2 years.
Okay.
But to his point, our opinion is most of the good stuff that you would want to own to resell has already been picked over.
Okay. Also, on to commercial then,
yes.
where you see the more opportunity there.
Okay.
What cities are we talking about?
Secondary markets, for example, in these sand states. So we'd be looking at Tampa, Orlando. We'd be looking at, for example, Scottsdale, Tucson, places like that. Those types of secondary markets where there's continued inflow or in-migration and immigration. Those areas and those states tend to be growing at faster paces. Also parts of the southeastern United States. For example, Charleston, South Carolina, secondary market. A lot of people like it and are moving there.
But is there a reason why some of those states might have, or not states, but cities might have been ignored because, companies were pulling back? There were massive job losses. There still are. And so, is there really this expectation that there's a spillover effect into these secondary cities?
There has been, but the good part about that, and this is really a national issue, is there's been no net new production of real speculative or commercial real estate development. So if we've had no development for 4 years, the lead time to produce buildings, once you have permits in place and the lending vehicle or the capital to build it, you still have another 2 years. So we've had no production, yet the people still come, right? So the underlying driver for all real estate is population growth, right? Wherever you have people, you have to build houses, you have to build stores, shops, offices, so on, hospitals, and that's the drivers, the population. So focus on where the people are going in those secondary markets that are attractive, warmer climates, and then buy the properties we buy a lot of times in TerraCap at 50% or less of replacement cost of good quality assets that are less than 10 years old. And then we quickly are able to turn around, lease them up, predominantly because there have been a lot of what we call shadow tenants on the sidelines, knowing those properties were in foreclosure or those properties were in default.
And they're waiting to get in.
They're waiting for a new stable owner that will take care of deferred maintenance, also make sure that they can fund the tenant improvements.
And that's where you come in, Steve.
That's where we come in.
Let me just quickly play for you, though, why Sam Zell, who we had on last week, why he wants to stay, at least on the residential side, into the more urban, bigger markets.
Certainly, from a competitive point of view, it's pretty easy to throw up another apartment project in suburban Atlanta.
Yeah.
It isn't quite so easy to throw up one in New York City.
So he's a guy that on the residential side wants to stay in places like San Francisco, wants to stay in New York, and avoid some of these other cities where sprawl is a big problem.
Right. And what he's doing there is the areas he's talking about have land constraints, right? So the cost of entry is higher in those markets. So he can buy a multifamily, highly occupied property for less than it would cost to build it. So that's why he's focusing on it. So right now, there's a lot of people, though, that are exiting multifamily properties. We just bought a 196-unit condominium, broken condominium that turned into an apartment complex. It was apartments, went to condo conversion. This was in Florida, Southwest Florida. We bought it at $41 a square foot, or $41,000 a unit. Previous highs were selling at $220,000 a unit.
Wow. My goodness.
It's a nice holiday gift for our TerraCap investors.
That's right. That's some spread. Steve, thank you so much. Great to have you with us.
Appreciate it.
Hagenbuckle of TerraCap. Up next, the holiday.